And the problem is, if that does happen, I am genuinely frightened. I want to be abundantly clear about that. Frightened by what it would mean to try another 4 or 5 years of the same old crap, particularly if that comes alongside slashing interest rates back down to zero again. All the things we've tried and failed. We try them again now when you've got inequality where it is, where you've got political polarization where it is, where you have institutional failure like Harvard at the level it is now. I don't know if we can recover from that.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. In my recent interview with Felix Zulauf, he mentioned that we're shifting from a unipolar world order into a multipolar world disorder. The majority of folks who watch this Thoughtful Money channel are primarily from the US, Europe, and Australia. So to provide a perspective from outside the West's point of view, I'm pleased to welcome Michael Every back onto the program. Michael is global strategist at Rabobank, and he's based out of Singapore. Michael, thanks so much for taking time out of your busy morning to join us.
You're very welcome. Glad to be here again.
Well, thank you, Michael. Look, a lot to get into, and it's been a while since you and I have talked. A lot has continued to happen on the world stage. A lot of people have been asking for your return to the program, so very glad you finally have been able to get time together here with you. A lot of questions, but let's start with the general one I like to kick these off with. What's your current assessment of the global economy and financial markets?
That's a fantastic question. Anytime it's asked at the end of a year, which has been a real crazy year, ahead of another year, which looks like it's going to be a real crazy year, it's the perfect time to ask it. I had 2 titles that I was playing with for my 2024 outlook, which you have to kind of start fleshing out this time of year. So originally, I was going to go with the movie title from years ago, The Year of Living Dangerously, which was actually about events in Indonesia in the past. But I thought summed up the totality of what we're looking at in 24. And I still like that one. But actually being more specific, because markets like things to be really specific, I'm now playing around with instead bullets, ballots, and beeps, as in basis points. Because I think really that's what 24 is going to be all about. It is dangerous, but it's this intersection of elections, war, and the yield curve. And they all join together. If anyone's an expert on only one of them, they're missing the whole picture.
All right, and did I catch that right? Bullets, ballots, and bips?
Yeah, bullets, ballots, and bips, yeah, or beeps, as we say in English, but yeah, English.
Yeah, exactly, British English. Okay, great. Well, okay, so hopefully most of the questions I have lined up here will kind of help us touch on each one of those. And why don't we start with the beeps, or the bips, as us Americans or want to say. Central banks. I know that you've been writing a fair amount about this. I guess my general question is sort of like, what do you expect next from the Federal Reserve and its brethren? And let me just give a little bit of context to the question, which is that, and you've written about this a lot recently, Wall Street at this point is positively salivating for rate cuts at some point in Q1 of next year. Honestly, you could say that that's sort of been the story for the past year year plus of the Fed's hiking cycle, where the market has been just expecting a Fed pivot. And every time Powell's had to say, nope, higher for longer, nope, higher for longer. And the market has had to adjust. Now, it hasn't mattered. The market's powered to, pretty big highs this year through all of that. But right now, that is absolutely the dominant narrative here, at least in the US and at Wall Street. Having read your recent commentary, I think you're a bit skeptical of that. But I guess, look, we've had tons of liquidity being pumped into the system, even though we're theoretically in a tightening cycle here, and the Fed is supposed to be putting on the monetary brakes. I've got a chart I'll bring up here in just a second, but we've had, sort of almost stealth liquidity coming from the reverse repo program, from the BTFP, from the deficit spending, the sort of wartime levels of deficit spending that we're having here in the US. And now with the markets having done as well as they have, financial conditions have been loosening, which kind of flies in the face of all the tightening efforts that the Fed is at least titularly been trying to do here. So one might say that might make it harder for the Fed to achieve its 2% inflation objective. But anyways, there's just a lot of cross currents in the mix here, but a lot of optimism right now on Wall Street again that those rate cuts are coming. What do you think?
Well, let's start with Wall Street. Just to reiterate for those who haven't been reading what I'm writing, Wall Street at the moment, yes, is extremely happy. It's giving itself this year's Christmas presents and next year's Christmas presents, very generous ones, in advance. But unfortunately, far too much of the street really just is involved in frivolity, what Marx would have called fictitious capital, and what in more plain English we could just call bullshit. And there's just an enormous amount of that about. Of course, they're going to price for those Fed cuts because that basically keeps them alive, keeps their bonuses up, keeps them in a job. So of course they're going to price for a scenario where not only do they keep their job next year, but the bonus packet, is bulging. Are we going to see it? Well, look, from a Fed perspective, every central bank's different, but from a Fed perspective, we could see a scenario where you get a couple of cuts next year from the second half of the year, not earlier than that. 2, 3, that's possible. But if you've got inflation heading down in that scenario too, your real rate of interest actually hasn't declined that much. So your real rate of interest actually is still going to be pretty high, pretty tight, pretty painful for most people. And that's pretty much your best scenario. Because on one hand, if the Fed has got this wrong, which is kind of like Wall Street is expecting and cheering for, but at the same time not seeing all the consequences of that, we are going to have a very painful downturn, a very painful recession. Really, the kind of gut punch that the US economy is in no position to handle when you've got a society this polarized and this many angry, unhappy people already. Nobody wants to contemplate that, certainly not Wall Street. But that is a risk, not a forecast, but a risk. And on the other hand, if you add to all the long list of things that you just came up with saying these are liquidity injections that we have to be aware of, there's another factor here, and it's one that we have discussed together in the past, but I think is incredibly pertinent, which is the Fed isn't even in control of this process anymore completely. They may be trying to run a pseudo Austrian-ish policy at home to try and get rid of some of this frivolity, fictitious capital, and bullshit, and all power to them if they can do that. But from an international perspective, you do still have a geopolitical struggle between a Western world and a global South, between the G7, G20, and the BRICS, between those who would prefer to use commodities as the bottom tranche of the collateral pyramid in the euro-dollar system or as an alternative to the euro-dollar system, and those who want to keep using the US dollar as part of a global system. And the long and the short of that is this. If the Fed cuts too much too early, even if it thinks it sees the right indicators from a domestic perspective for that to happen, if it hasn't broken the back of the frivolity, the fictitious capital, and the bullshit in Wall Street, and it hasn't broken the back of its geopolitical rivals internationally, as soon as those rates go down, you will see every asset class go through the roof, which is what Wall Street wants, and every commodity price go through the roof, at which point inflation comes roaring back, and the Fed will have made exactly the Arthur Burns 1970s error that it's so very adamant it isn't going to make. And that's an international argument, not just a domestic one.
All right. So super interesting. Okay, so basically Fed pivots too early and it falls into the trap that it seems to be so desperate not to fall into again. In other words, making the Arthur Burns mistake. God, so many questions about this. I guess first off is what do you think, and I'm asking you to just totally speculate here, but how aware of this danger do you think the current FOMC is?
It depends on the actual member. I'm not as well placed as maybe some other guests you have who might know some of them personally because they're Americans and have mixed in those circles for a long time. I'm here in Asia and I'm a Brit, so no insider connection. But certainly, if you look at the background of some of them and the reasons they were appointed and their particular viewpoint, both politically and geopolitically, I think some of them are pretty wise to it, and I think some of them are absolutely naive to it. Particularly, for example, those who are more dovish, and Goolsbee in particular, let me just bring him up openly. I think he's the kind of thinker who very much focuses from a more Keynesian / modern monetary theory perspective, which is, if we put enough liquidity into this, we can make it work. Well, that relates to a point that I've made repeatedly in the past couple of months in my daily note when I write it. It's actually Rabobank's daily note when I write the daily note, which is that Keynes in 1942 gave a very short speech saying something very important, where he said, anything we can do, we can afford. And if you think of it, he's absolutely right. If you've got unemployment, if you've got spare capacity, if you've got idle factories, if you've got human capital just sitting there doing nothing, well, yeah, you can afford to do anything. The government can borrow and or monetize to mop up that excess capacity to produce output, which will produce revenue, which can actually be stimulative and can make things work. Now, yeah, there are ifs and buts and maybes to that, but overall, he was right. What do you do in a US economy where you can't physically do anything anymore? What do you do if you're going to throw stimulus into an economy where you don't have the factory capacity, you don't have the infrastructure capacity, you don't have the labor capacity? It's only going to be inflationary. And due to the genius of maintaining stimulatory policy alongside offshoring up until now, you've basically created that environment for yourself so that you will have that higher inflation kicking in if you try and stimulate in that way. The only way you can stimulate is going on the supply side, but the FOMC are not quite there yet to understand that.
Right, and they I mean, even self-admittedly, they don't really have a lot of opportunity or ability to influence the supply side, right? I mean, their levers are really more demand levers, correct?
They are, excuse me.
In terms of the economy, in terms of the money supply, yeah, they can provide supply.
Well, I mean, this takes us straight away to. It's good maybe to get to a real heavy point in the discussion early on, so we can go to new areas.
Go for it.
Because I think we've touched on this in past conversations, and if we haven't, let me be really upfront about it. I've had a thesis for a while, and it transcends where a lot of the argument is now between people who think, okay, rates can be cut versus rates have to stay on hold, or maybe even edge a bit higher. And it transcends the argument between those who say we need to tighten our belt because debt is too high, and those who say, no, we need to keep stimulating to try and keep things moving forward. My argument is whatever you say within that matrix, higher, lower, looser, tighter, you're wrong. Whatever point you pick now, you're wrong. There's nothing that will work for either the US or the broader Western economy from the starting base that we have now, which is a very weak supply side in terms of what can be physically produced, and the long list of geopolitical and political challenges we have, which require a lot of output, which we just simply don't have because we don't have the production and we don't even have the inputs anymore. We've kind of offshored all the inputs too. So what's the correct policy stance? You're going to have a rollback of policy to the way things used to be done before the 1980s, which very few viewers will remember. And, I was a kid in the 70s, but I have the vaguest of memories of what it was like in terms of what people were talking about around the dinner table. And, and I can read my economic history, which is you're going to have tighter policy and looser policy. You're going to have higher rates and lower rates all at the same time. And you're going to have to combine that with elements of protectionism and industrial policy and changes to every policy as part of a grand strategy to make sure you don't do stupid stuff. You only do relevant stuff. And the market is stupid. So the market will not do that for you with a high interest rate or a low interest rate. And the government is also stupid. So it won't do it with very loose policy or very tight policy. You have to change everything in terms of how we understand what we do. And the Fed will have to be part of that.
Okay, so I do remember this conversation.
I get this look a lot, head in hands, like what?
Yeah. Well, so a couple of things. So first off, I do remember this conversation with you, and it was basically that we are going to have to selectively target different parts of the economy with different policies, right?
Correct.
Yeah,
correct.
And that's the way we're going to have to. You think we're going to have to play this, and I'm thinking of 2 other movie titles. One was No Way Out, which is,
Yeah, yeah.
I hear your Matrix and I'm like, yeah, I get it. And then I think about, okay, so we need to basically have, you know, a very intelligent, surgical approach to figuring out, you know, this sort of patchwork quilt, where are we going to ease, where are we going to tighten? But when I look at the people who we're relying on for that, they have a horrible track record. So I think of the movie Idiocracy, where I'm just like, Michael, I just don't know. I just don't know with the team of leaders we have if we're gonna if we can really expect anything other than disaster from that.
Well, if you're thinking that, you know, Janet Magic Mushroom Yellen is going to be the person who can do this, then you're absolutely right to be skeptical. I mean, power abhors a vacuum, and cometh the hour, cometh the man or the woman.
Mm-hmm.
And I do think eventually you will get that leadership. Let me just try and point to one or two things I'm seeing around me, and maybe in Rorschach fashion, I'm overstating it, but I do think that they are starting to be some of the dots that if you project them forward, you can see how this may begin to happen. So first of all, there's a lot to dislike about Bidenomics, but some of the direction is heading in the kind of general path that I'm talking about, which is saying, okay, this is an important sector. That isn't, but we want the market to operate in this environment. So here's a subsidy for X. Here's a tariff, so you can't get it from abroad. So we're already moving down that path, okay?
Okay. And sorry to interrupt, but like, would an example of investing in manufacturing capacity inside America, would that be an example of?
Yeah,
Yeah.
exactly. For example, they're saying like we want to build EV battery chains, now battery supply chains. I'm not saying if it's a good thing or bad, right? I'm not trying to take a political stance one way or the other. I'm saying that's exactly the kind of policy I said,
Yeah.
years ago would emerge, because we want this, we want it made in America, and we want to incentivize the private sector to do it for us rather than there being government money. So we'll use a combination of subsidies and tariffs to make sure it's cheaper to do it here.
Yeah.
So they're doing that. It is having a real world impact in that particular sector, a big one. The industry is being sucked up from Europe in particular and moving to America because of cheap energy costs as well, but partly because of that investment framework. So that kind of thing can work. And even with the very limited human capital we have in Congress, that's kind of already happening. Then there's another one that I just saw this week. Del Toro, the US Navy Secretary, has given a speech in which he said that we have to, or let's say we, the US, has to reverse its long-run decline as a maritime power, a merchant marine power, which is something I was arguing 2 years ago in my report called In Deep Ship. And history said that the US would reverse it. And to do that, you've got to build many more shipyards again in order to build many, many more commercial ships to rebuild your merchant marine. Because the spillover from that means you've got the spare capacity to build military vessels, military ships, as and when you need. Because right now you can't keep pace with the combined total of the US geopolitical enemies, who are all about production, whereas the US is more about financialization.
Yep.
So he's already talking about openly getting all the bureaucrats to talk to each other, which is one big problem. And on the other one, he's talking about using a Reagan era, I think it's called Title 46. I may be misremembering that, but it's a Reagan era policy tool still available to them. That if the Secretary of Transport signs off on it, and Homeland Security, and the head of the Navy, if they all sign and tick, you can build a ship in the US with a 50% discount, with the government basically paying the rest for you. So in other words, you subsidize shipbuilding back in the US again.
Mm-hmm.
Now, at the same time, then you need to have shipyards, because where are your shipyards? Well, he's talking about getting Australia, Japan, South Korea, all the big shipbuilding or steelmaking nations to come and reopen shipyards in the US, which the government will make profitable, because you're going to have a guaranteed flow of vessels being built over the next 10, 15, 20 years or whatever, to make sure it's worth making that investment. So again, you're changing the framework that the market operates within, using subsidies and tariffs. And you're doing that to try and retake commercial control of the high seas, which is a great idea for the US, by the way, and to give yourself the wiggle room that if you need to then shift to military production, you can. It's a tick exercise everywhere you look.
Yep.
But it's free money. It's a 50% discount for the right sector. It's kind of like BTFP, which is what you were referring to, but for the real economy rather than the financial economy.
Okay. So this is super interesting. And, I'm sure there are probably some folks that are watching who are hanging on by their fingernails trying to follow everything here. But let me ask you this, Michael. So, we just got a front row seat in terms of what it looks like when your supply chains are overextended and you're too dependent upon other parts of the world for, essential goods and services inside your own nation, right? I mean, sort of everybody kind of got that during COVID, right? I think it probably makes sense to a lot of people watching that, yeah, you know what, we probably, to be a more resilient nation, we probably want to reshore, friendshore, take a more intelligent look at our supply chains. And I'm sure there's a huge appetite from a lot of viewers here to say, look, let's not just throw all the stimulus into the financials, into financialization. Let's put it in real things that like make real things, create real jobs, benefit us as world citizens. So to a certain extent, I think people can kind of get behind some of the spirit of what you're talking about here. If we do this, let's assume for a second we even do it intelligently, right? What's the lived experience going to be like for the next, well, for as long as it takes to do this? And this isn't like it's not like something that's going to be over in just a couple of years, right? We're talking about a grand scope of at least a couple of decades of this sort of rebuilding and surgical dialing up and dialing down of parts of the economy. You're nodding as I'm saying this, but please correct me if I'm wrong. What will that look like? I mean, will this to a certain extent be inflationary because we're spending lots of money and employing a lot of people and driving wages up? And, obviously, if we're going to be subsidizing foreign countries to come build here, I mean, it sounds like a lot of spending. And maybe that is the right thing to do. Or will there be savings that will offset this when you talk about sort of feeding parts of the economy and starving other parts? Like, what would it feel like to live through this as a citizen?
Well, first of all, we'll find out. But secondly, if you look at history as a lesson, effectively you're reversing a lot of the effects that you've seen over the past 40 years. So instead of there being an agglomeration of power in the East Coast and the West Coast, it will go back towards more traditional manufacturing sectors and towards the South, obviously, like Texas and Florida are already doing well, as we know, within the US.
Okay, I can see a lot of people, except the bankers, kind of cheering that. So, okay.
No, well, yeah, exactly. And there's another one. So who's done well out of 40 years of globalization and financialization? The bankers, Wall Street. This would literally be, and again, I'm not in any way making this a Democrat or Republican issue, because the Republicans, trust me, have their own version of this as cooking that we can discuss in a moment. They have a different way of doing the same thing. This is good for Main Street. It's very bad for Wall Street. Is it inflationary? Of course it's inflationary. There's an enormous amount of capital spending going on right the way across the economy, where you have structural shortages, and you will have structural shortages for year after year after year, until you eventually, with a J-curve effect, manage to start generating more output. So it's inflationary long before it's deflationary or lowflationary in those sectors. But it's designed to be lowflationary in those sectors because you're producing output at scale, which is how the US always used to bring down the cost of goods versus Europe. We'll just make it bigger. We'll go bigger and bigger and bigger, produce more and more of it. The unit costs come down, and actually we make more of it. We flood the world with it, China style. That's what the US used to do. Mm-hmm. Now it's all about moving, numbers around on a screen, and and Gordon Gekko style spibs, basically saying, this is the route to wealth, right? So obviously those guys are going to hate it. They'll lobby against it every step of the way. They are going to have to be part of the process, because the government doesn't want to run everything in a kind of a socialist manner and say that, we are going to dictate where everything goes. They just create the framework and let the water flow. And some of the guys who are surfing on that will still be Wall Street types, and they'll still make money. But they're not going to make the wild, crazy money that they have done. It will be much more, cuff and collars in terms of where it goes and how much you can make out of it. And if you're doing stupid stuff, absolutely irrelevant, stupid, short-sighted, idiotic stuff, which is of no value to the US as a US Inc., great power in the world, attempting to try and maintain its status, I think you're going to have a hell of a time of it. And I mean that in a negative sense. I think it's going to be an awful 10, 15, 20, 25 years. And, my heart bleeds for you, quite frankly.
Okay. Well, and sorry, you just, I think we're speculating here, but you pulled a number, I think, of like 15 years out of the hat there. I mean, is that sort of the time frame you think this engineer, and of course, it's not going to start one year and just stop the next, but it's going to require that type of time commitment, it sounds like.
Oh, absolutely. I mean, we are looking at a multi-decade period of time to disentangle supply chains from China, to nearshore them, friendshore them, and to a large degree onshore them, depending on where the priority lies, to rebuild the logistical networks that go along with that, to reskill the relevant parts of the workforce again, or to fully automate where you can't get the labor, all of which is, as I said, capital intensive, is going to take 20 years.
Okay.
And during that period, can you have pockets of deflation? Sure.
Sure.
Can you have unexpected downturns? Absolutely. I mean, I'm one of these guys who always says to you, life isn't a straight line. I can't stand these forecasts that don't show that actually life's more like this, right? So, of course, you're going to have them. But anyone who thinks, even in 2024, that rates are just going to be slashed again, that's it, we're going all the way back to 2008, that's the only way out of this, I just don't see it. And if we do go that route, and it's a separate conversation, I'm really scared by what that actually means.
By what that means.
Yeah.
And when you sort of talked about your matrix there, and I came up with no way out. I mean, do you see this as this path we're talking about as pretty much the inevitable one to get to a better tomorrow? Like, in other words, like, even if we do something different for a while, maybe the thing that scares you, it's not going to work, and we're eventually going to have to find our way back to this type of path. Is that sort of how you look at this?
100%. I do very little except think about this future, what alternatives there are if you try X or Y or Z, or which combination might possibly work, presuming that the players on the other side of the field do A, B, or C. I game this out all the time. I have done for years. And the simple fact is, people who are experts in one area, be it the Fed, be it an equity specialist or whatever, yada, 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 until you join it all together, you will be wrong, because you'll keep thinking that some narrow aspect of what we've already tried, as I said, looser fiscal policy, wrong. Tighter fiscal policy, wrong. Higher rates, wrong. Lower rates, very wrong. None of them will work. Free trade, absolutely, will not work globally. Protectionism, universally, won't work. It's going to have to be some protectionism, some free trade, some higher rates, some lower rates, some looser policy, some tighter policy, in order to turn the ship around. And there's nothing else that will work for the US. And that doesn't mean, to go back to your earlier point, that we will do it first. Because what did Churchill say about the Americans?
I'm thinking of the exact same quote. Yeah.
Yeah. You always do the right thing after you've tried everything else. Yeah.
Exactly.
But you have tried everything else. And just to underline a point I was making a second ago, people might think, okay, so I'm backing Bidenomics by what I've said. That's not what I'm trying to say. I'm trying to say that there are elements of it which I think.
Yeah. I don't get that sense, by the way. I don't get. Yeah.
Okay. So I'm not political like that. Okay. But the Republican side, if you look at what Trump's suggesting, because people are not paying attention to his policy platform. Excuse me one second.
Sure.
Sorry, frog in the throat. If you look at what Trump's suggesting, he's talking about a quasi-Hamiltonian policy. And this is something that most Americans have completely forgotten about. I mean, Hamilton was responsible for the intellectual framework which made the US a giant it is today, rather than being a farm growing food for the British. You didn't have any industry, but he said we have to have industry, otherwise we're always just going to be bullied by everyone else. We'll be, safe and a vast land, but everyone will tell us what to do. So what did he do? Well, he argued for very high tariffs to make sure that everything that you needed would be made in America rather than being imported from the industrial powers. High land prices as well, which would of course be popular with some elements on Wall Street. And then you tax land, and you take the tax revenue from tariffs, and you keep local production costs low. So Trump's talking about a universal tariff on everything coming in. It's not very geopolitically smart, but I understand where it's coming from.
Mm-hmm.
And then slashing the cost of production in America. And if you look at the American compass, like I think they're beyond Trumpism, the national conservative movement within the Republican Party, who are, currently on the fringe, shall we say, but moving more and more towards the center every year when the traditional Republican policy fails again and again, which it always will do now in this environment. They're arguing for something similar. They're saying, like, we need a new social compact with labor. We need a national investment bank to build infrastructure. We need selective protectionism. We need to re-regulate industry to make sure that it's got a national focus, which is what Hamilton would have backed, as did Adam Smith, as did David Ricardo, by the way. We need to make sure the money stays at home and circulates locally. And and we need to break up monopolies. And I'm not sure if Trump will do that. I think he's big on mergers. But that's another way you can go. But then you can say, right, here's a giant American company. Now you work for Team America. So we've let you get big. Now you do by one phone call what we want you to do. That's the Chinese method. So there are lots of different ways to get to the same general pattern, which is it isn't going to be what it used to be.
So what's so interesting to me on this, Michael, is so much of the outcome at the end when the dust settles, from, if I'm understanding you correct, I mean, it sounds pretty aspirational. Like it sounds like a lot of things I think most people would say, yeah, that sounds pretty good. Like I remember in one of our first interviews, you talked about the multi-decade suppression, or let me put it this way, the field had just been so increasingly tilted towards capital versus labor that you said if labor looks like it's going to start getting any sort of advantage, that's when the central banks are really going to kick into action, because the whole power structure right now is sort of set up to protect capital. But what you're describing sounds like a way to maybe even the playing field a little bit. It sounds like it's not going to be as easy to hoover up, all the advantage in the world on the capital side, and labor may get a little bit of a fairer shake, right? And if local production costs are low, that hopefully keeps cost of living, controllable for people. From a national standpoint, we'll be a lot more resilient, both economically and in our defense and all sorts of other things, it sounds like. We'll be reinvesting in real things. So much of the economic attention will be on things that actually create value and do real things, as opposed to just move paper or ones and zeros around from one rich person's pocket into another. I'm maybe painting with a little bit of too much of a Pollyanna-ish brush here, and I know some people will be rightly concerned that it sounds like the state will be playing a somewhat heavy-handed role here at times, and to a certain extent picking winners and losers, which a lot of people, myself included, are not completely comfortable with. But in total, what you're describing, it doesn't sound all that bad. Like even our current system of capitalism, I've railed with many other speakers on this program, Michael, that it's really a captured form of capitalism. It's a corporatism, it's a cronyism. There are a number of, if not monopolies, kind of corporate cartels right now that I don't think too many people would shed a tear if they got broken up a bit and allowed for more competition. And you didn't have the ability of, a very small cadre of people to own like the vast majority of the nation's wealth. So when you think about this, what, if anything, kind of concerns you about this solution?
Well, first of all, thank you for that lovely, eloquent, better than I did summary of what I'm trying to put forward. That was very nicely put. The downside is this. The reason why I pivoted from the earlier view that I expressed to you the first time we spoke, which is that central banks would do everything they can to try and push down that wage growth, is because at that point, and I think I've used this analogy before, we were in a Marxian world, labor versus capital. Central banks clearly represented the power of capital. Well, we've moved from a Marxian world to a Leninist world of political violence and revolution. And in that environment, you can see that Western society is fracturing, and it's fracturing pretty badly and pretty fast. I mean, just look at the congressional testimony, of the elite university presidents and the absolute moral scandal that you saw there recently, which has finally got the public focusing something that many of us have been aware of for a very long time, and which is far more widespread than just at those elite universities, by the way. It's a huge issue, and right the way across the West. So you've got that in terms of societal polarization and dispersion, if you will, which ultimately will come for Wall Street. If you're going to have a society where everyone is an oppressor or oppressed, and you can use violence as the oppressed, there isn't a single person working on Wall Street today who isn't going to find themselves in the crosshairs of that at some point. And so, forget about a comfortable retirement. That changes the game for everyone. That changes the game for central banks too. They suddenly realize, and I'm next on this list, or a couple of names down, so this cannot continue. And then geopolitically, and in parallel to that, and with one feeding the other very deliberately, you have obviously the tensions with Russia, the tensions with China, the tensions with Iran, the tensions with North Korea. You have, a series of wars taking place around the world, which I think will grow. That list of wars will grow, and I think those wars themselves will escalate. Not to World War III, to be blunt, but enough that we're no longer living in a peaceful environment, but we recognize we're living in an environment of war. So if you have those together, that's why I said that we would shift from a Marxist view to a Leninist view. That's why I went from lower for longer, which I was for 20 years, to higher for longer now, or war for longer, which is generally speaking higher for longer. And it's certainly higher for longer for those who are not doing well in the war. If you're doing well in the war, you can afford lower for longer. If you're not, you need to be higher for longer. But obviously that shows you that this transition, let's call it a transition, is going to be very hard fought. There are going to be very, very powerful actors domestically and internationally who are going to use every tool at their disposal to stop it happening. And some of them are going to be peaceful and some of them are going to be violent. And the battle to achieve this outcome will take year after year after year, election after election, and it's going to be really volatile.
All right, and let me just push on this, because this goes back to my earlier question, which is I totally agree. Even in the best of times, the people who benefit from the power structure resist change, with every fiber of their being, right? With every strategy at their disposal. A lot of what you're talking about is disruption, and it probably won't be popular disruption in a lot of places at the beginning, right? As certain parts of the economy are told, all right, you're going to get starved, right? Because we're going to feed these guys over here. There's going to be a lot of sense of injustice. People aren't going to totally understand the big picture in every case. It's going to need really strong, capable, and consistent leadership to drive this through. I'm concerned that we don't have it right now. I'm not even necessarily sure you're saying it's gonna, maybe the seeds of it are being sown right now, but maybe we don't have the leader who's going to drive it through. As somewhat of a student of human nature, I feel that, to your point about Churchill's quote, like, people resist and fight change up until the point when they realize the pain of continuing the status quo is higher than the pain of change, right? So my point is we're probably going to have a lot of pain before the nation sort of rallies around this type of surgery that you're talking about. And that might be pain caused by us making the wrong decisions for a while and then blowing up in our face, or having a weak or poor leader try, to kick this thing off or whatnot. So, just like, the person doesn't change their lifestyle until they've had that first heart attack. How much pain do you think it's really going to require before the right leader is revealed and the people are willing to line up behind that leader?
That's a very good question. It's very difficult to say precisely because it depends on the country and the culture and where the individual, pain thresholds lie. You can be optimistic and say we're already there, because the experiences of the past 3 or 4 years have just been awful. I mean, COVID, my God, we've tried and blank out what a terrible bloody experience that was for 2 years. Then 2022 with the energy crisis, the food price crisis, et cetera, absolute shocker. 2023, we've had sky high interest rates, sky high inflation, and another war starting. We're not even halfway through the decade yet, and it's every bit as bad as I feared the 20s would be. I think I remember telling you early on, I was laughing at people who said this will be the Roaring 20s, talking about the Great Gatsby. I'm like, have you read the history of the Roaring 20s? We're talking about a civil war in Ukraine. Hitler tried his first putsch. There was a civil war in China. Just unbelievable bloodshed and misery and chaos right the way up until the last little bit, just before the stock market bubble blew up. I said, don't make a comparison with that decade. It was awful. Well, here we are. But the optimist view might be that we've had enough already, and you are starting to see, I think, a really sea change in politics in Western democracies. Now, you may approve or disapprove of the individual election results in country after country, but I think people have had enough. I think you're starting to see people say, I can't think of things in a three-dimensional, multidisciplinary, cross-asset, cross-geography sense, the way that, schmucks like me try and do. And I underline try. But things are not working, and I want things to be done differently. Yep. And yeah, you can be missold the same old policies again by the same old people for a while. But the optimist will say we're already there. We're just waiting for someone to be able to coherently put that policy framework together. Now, the pessimist will say, no, we'll have another.
Sorry to interrupt you, but before you get to the pessimist, just to make sure I understand your optimist point there. That political movement you're talking about that we're beginning to see, it's more of sort of like a, look, I don't care so much about the grand, globalization, World Economic Forum, we're all holding hand, kumbayas in the world. Our country is not being run well. Let's clean up things up here at home first, right? Some might call that a little bit more of a nationalistic platform, but
Sure.
is that the movement you're talking about? Like, hey, let's clean up our own mess for ourselves first?
Yeah, completely. And by the way, this was completely predictable, because if going back, 4 or 5 years, you looked at the policy framework we had and you said it doesn't work, which I did, and I did. I said that ultimately left versus right would no longer be the argument, because left doesn't work, right doesn't work, higher taxes don't work, lower taxes don't work. None of them will solve what's going on domestically and internationally in terms of, rebalancing power domestically and internationally.
Yeah.
So I said that the ultimate emergence would be between people who say we want to think nationally, and then maybe think nationally in conjunction with other countries who are thinking nationally. So nationalists of the world unite, if you will, which is kind of an ironic way of looking at it. And people who think, no, we have to go to the highest level, sit in the cockpit and have everything controlled from Davos. And that will be your tension. That's exactly our tension. That's exactly what's emerged. Now, there are strong points and weak points in both camps. But I think if you look at the recent trend in election results across Western democracies, it's very clearly moving in a more nationalist direction. Can that be mismanaged? God, yeah. I'm a Brit. Look at Brexit. If you want to talk about mismanagement of a nationalist policy, there's Exhibit A. Does that mean it's the wrong impulse? Not necessarily. It just means it needs to be done right rather than by charlatans. It's got to be done carefully and logically with a strategic vision rather than flag waving and just saying, let's shift from metric to imperial measures, as if that's going to somehow rebuild the British Empire, right? So I see that happening, and that's the optimist case, that we're already getting the wind in our sails. The pessimist case is that we'll just be missold the same old crap again for another 4 years. And the problem is, if that does happen, I am genuinely frightened. I want to be abundantly clear about that. Frightened by what it would mean to try another 4 or 5 years of the same old crap, particularly if that comes alongside slashing interest rates back down to zero again, and/or tax cuts, and/or more free trade deals, and/or more deregulation, et cetera, all the things we've tried and failed. We try them again now when you've got inequality where it is, where you've got political polarization where it is, where you have institutional failure like Harvard at the level it is now. I don't know if we can recover from that objectively. So that's the pessimistic point of view, that if we kick the can down the road another 4 or 5 years, I don't know if we emerge okay at the end.
All right. I don't want to be the wet blanket in the room, but calling shots from my seat here in the U.S., I'm feeling much more like the pessimistic view is probably going to prevail. I don't see us getting our act together and lining up behind these policies. It's just not happening, at least right now, at the national consciousness of the average guy here. So unless our politicians are somehow locking arms on this behind closed doors away from the C-SPAN cameras, because right now it looks like we're as divided and partisan as we've ever been in the halls of Capitol Hill. So I don't know. I don't want to make you lose additional sleep tonight, Michael, but I would take the under on the optimist versus the pessimist bet there. Hey, a couple quick things. So first off, what do you call this model? Right, when you this sort of surge, do you have a term for it yet?
Yeah, I do. I mean, look, you could call it, the original name I had for it was post Keynesian.
Post-Keynesian, okay.
Yeah, it's a bit technical for viewers. If you're a Keynesian, you think the government can just spend, right? Just borrow. Post Keynesians make that argument, anything we can do, we can afford, which is, if you've got the industrial spare capacity, you can do MMT. You can monetize to get the parts of the economy working you need to get working. If they're just sitting there idle, in fact, you should do that. That's a post-Keynesian argument. This is a post-Keynesian argument because you can't do it if you don't have any spare capacity. If you've taken a developed a market like the US, DM, developed market, and you've effectively made it into an emerging market, EM, by polarizing the population in terms of income and wealth, dismantling the education system so most people are functional idiots rather than actually capable of having rational conversation, ruining your political process one way or another, and then removing your industrial capacity so you can't make anything anymore. You have to buy it from everybody else. You look just like an emerging market, and you will have the volatility of an emerging market, at which point the only policies you can use are the development policies that emerging markets use, which is, okay, let's go back to the early American experience, high tariffs, protect infant industries, more prickly, more porcupine-like, more defensive, more realpolitik. Let's presume the world is out to get us rather than the world is out to supply us with cheap stuff just because we're America. So it's post-Keynesian. That's one word for it. Another word would just be realpolitik. This really is just the way the world always used to be until after World War II. That it's all against all, trying to keep domestic stability and trying to keep your head above water internationally.
Okay, I was going to say we're going to have to work on the branding if it's post Keynesian, but realpolitik maybe gets a little bit closer to that. But I'll put the branding team on it, Michael, and we'll
please do.
I'm
not running for office, but it would be great if you can come up with something. I'm quite good at catching names.
I was thinking of something like neo-Hamiltonian, just because of the popularity of Hamilton.
There you go.
You might sell that to Americans, right?
There you go. Yeah, neo-Hamiltonian. It is that too, in a nutshell, actually.
Okay. Well, look, you talked about the whole geopolitical element here to this, and we have in the past talked about, I started this video with mentioning Felix Zulauf saying, we're kind of shifting from this unipolar world order to a multipolar world disorder. In the past, when you and I have talked, we've spent some time talking about the division between Team West and the BRICS. And, of course, a lot of speculation going on right now about how, those are going to be sort of the two big powers, coalitions that are going to be determining the future. Very well still may be the case. But I do remember you saying, because you have spent time in both countries, notably Russia and China, you've said, hey, look, guys, folks that are expecting Russia and China to kind of win this game, and particularly win this game by collaborating really closely together, you were very skeptical of that. You thought that those countries had a lot more internal shortcomings, maybe even decay, whatever. I don't want to put words in your mouth. But also the fact that, a lot of this sort of Team BRICS coalition are countries that have had, to put it, as kindly as I can, like, really rocky relationships over the past centuries and millennia, right? So to expect them to be this sort of united, confederation to take on Team West, they're certainly trying to do it. They will certainly likely have a certain degree of success for it. But if I remember correctly, you were saying, don't give them too much credit. Is that still your point of view?
Broadly speaking, yes. But let me use an analogy of like a card game. The other side really have a not particularly good hand in most respects. Let's say they've got a pair of sixes and a pair of eights or something like that. Not two pair. One's got a pair of sixes, one's got a pair of eights. They're not amazing by any means. They can't combine it into one hand, to have two pair, which would be nice. It doesn't work like that. And the West has a far better hand collectively as the West. What has disappointed me over the past year in particular is that you're seeing the West, for example, sit there with three aces and say, well, I'm just going to burn one. And I'm going to, and I'm just going to throw the other one out the window just because. And it's like, well, yeah, if you're going to do that, then suddenly things start looking really pretty rocky. There are any number of specific details I can drill down into, but I won't bore you or the viewers right now with it, where the West has had a winning hand, a running royal flush. And
it's folding?
Just decided, yeah, I fold. It's like, well, what the hell are you doing? What the hell are you doing? So they're not winning yet, the other side. They still have serious issues. I mean, just for example, just today on social media, I saw a reiteration of a point that when I was covering the Chinese economy, I was making again and again, and people didn't believe me. Their cumulative fiscal deficit, including the local government, which is a big spender, is 17% of GDP. 17. You want to talk about a wartime fiscal deficit?
Yeah.
It's a wartime fiscal deficit, 17% of GDP. There is no way back from that. There's no way out of that. They are in a world of hurt, okay? But if we are going to keep folding, which we do geopolitically, economically, because we're afraid of the friction which is going to happen, and the tension which is going to happen, and the volatility which is going to happen, alongside this necessary transition to narrow our own internal gaps, change the balance of winners and losers, and strengthen our position geopolitically vis-a-vis others. If we're going to keep folding and saying, well, I don't want the tension, I don't want the hassle, I don't want the volatility, then we keep folding, then we will lose. So it does worry me.
So can you give me an example there? Let's say, Michael, I make you the advisor to Team West here. Give me an example of something that you would say, all right, guys, look, don't do that. That's folding. Do this instead. This is a power move that's going to serve you guys.
Okay, well, let's take a European example because, I work for a European bank. So when the Europeans tried to impose, sanctions on Russia very, very half-heartedly, in no time at all, you got German exports to Kyrgyzstan, little tiny Kyrgyzstan, rising 5,500%. Who do you think that stuff's going to?
Right.
How much brain do you need to see
that? I imagine similarly, all of a sudden their purchases of Indian oil, go through the roof, and where are the Indians getting that oil from?
Well, on that front, I've had it on, I didn't hear it directly, but I heard it from someone who heard it from someone directly. So, Chinese whispers to a degree, but it came from a credible source that actually the US were told India, keep buying. Like, we want you to buy Russian oil and we want it to get back into the market. So, so they were well aware of the fact that it was a shell game, which, you can believe that or not, but it's just, an interesting fact.
Well, if it's true, it didn't make me feel any better. Let me put it that way.
No. But I mean, from Europe's perspective, where it was much more existential for them, the Greek tanker fleet immediately started to help shift Russian products by, kind of turning off their transponders or, changing their flagging, whatever technique they used. So the Greek shipping oligarchs are making absolute fortune just moving Russian stuff when Europe at the highest level was saying we don't want it to move. So the West doesn't work very well. And I have to say that speaks to an interesting paper that I referred to in a Daily Note recently. I didn't need to read it because I could see it happening around me, but it's interesting when people do academic study to back up something that you're already seeing. They published a paper, I think it was at MIT, called War Without Gunsmoke. And these researchers basically said that when you look at a rising power, e.g. China today, e.g. Germany, early 20th century, and declining power, US today, UK, 100 and something years ago, when you look at the economic power structure within the two, because the declining power is much more internationalized and much more globalized, much more of the profit structure comes from offshore vis-a-vis domestic. Whereas in the rising power, it's still much more tied to the mothership, if you will. So as a result, if Beijing today or Berlin back then says, okay, we're going to decouple or we're going to do X, Y, Z, everyone says, yep, we'll follow your lead. Whereas today, if the US says, right, okay, we're going to decouple from China, you'll immediately have, 100 US CEOs phoning you up and saying, don't be stupid. My shareholders say X, Y, Z. It doesn't make any difference whether it's good or bad for America.
Yep.
It doesn't make any difference whether that means that firm will exist in 10, 15, 20 years, or whether the American standard of living will go off of a cliff. They couldn't care less. It's about the 3-month reporting to shareholders. That's all that matters as a holy mantra. And 100 years ago, the same was true in the UK. Apparently, I didn't know this, even though I know my economic history well. Early in the 20th century, the Brits were all for a preemptive war against Germany to nip it in the bud. They're like, we can see what they're doing. If we have a quick war with them now, we can take out their industrial capacity.
Yep.
And we can maintain our hegemony, globally, and not have a bigger war in Europe. But the City of London, our version of Wall Street, stepped in and said, you can't do that. They won't pay us back our bonds. Blah, blah. I said, well, I can't have that. In that case, right, let's not do anything. What do we end up with? World War I. So, yeah, the problem is the West can have the strongest hand, but the incentives you have within a much more dispersed power structure can operate against the overall good of the system as a whole. whereas the other side doesn't have that to the same degree. So that's a depressing fact.
It is, and it just, I mean, again, this would probably require, some more centralization of control, where they're just saying, look, these loose rules are not going to be permitted anymore, and there's going to be real consequences. Again, one of those instances where that's going to really rub a lot of people the wrong way, but it might be the right thing to do for a period of time. I'm going to leave that to smarter people than I to determine. All right, well, look, Michael, super fascinating. I could literally keep talking about this, honestly, for like the next 3 hours, because this is, if I just look at the questions I've written here while you've been talking, I've gotten like 2 of them. But let me, if I can, try to loop this back to the viewers here. So our viewers are regular investors. They're trying to crawl inside the minds of very smart people like you who have a very broad view of what's happening or likely to happen. And basically they've got 2 questions in their mind. One is, hey, if change is coming, how do I not become collateral damage to it? And you've just talked about a lot of disruptive change. And then also, if change is coming and I can avoid becoming collateral damage, is there a way for me to take gains through this or benefit, prosper through it? We didn't really get so much in your market outlook. We're not going to have that much time here because I thought the core of what we talked about was just a much more important concept to get fleshed out for folks. But as you look forward to this type of path you think we're going to have to take, whether willingly or kicking and screaming, will there be any sort of investment themes in it? In other words, like it sounds like there's going to be a lot of building. So will commodities do well? I mean, are there certain currency moves you think are predictable? Or again, are there any sort of grand themes from an investment standpoint that have popped into your mind as you've thought about this so closely?
Yeah, no, absolutely. Let's bring it down to nuts and bolts. It depends how it plays out. So let's go down 2 different paths at some point, right? But generally speaking, the first assumption is that at least while Powell is head of the Fed, that we are more in a higher for longer environment than not. That where you may get, excuse me, sorry, a moderate easing of rates at best, we're not going to get the kind of slashing of rates and all assets go up fun fest the Wall Street is currently pricing for. So current pricing is wrong. Now, does that mean that stocks go down? I don't pick stocks. I want to make that abundantly clear. All I'll say is there's an election in 2024, and I'll eat my hat if the Fed lets the stock market collapse ahead of 2024. There's always a way to game the system through a judicious speech or whatever to encourage irrational exuberance ahead of an election. So it wouldn't surprise me if stocks don't do well, regardless of what the fundamentals say they should or shouldn't be doing. But from a rates perspective, the best case scenario is that they come down moderately. If they do collapse, as I said, that's alongside a really scary downturn where all the kind of nasty political points and geopolitical points I've been referring to will be on our plate within months. Like, really, really big decisions on how do we do things? What do we do? How do we change the system? That will be front and center straight away. But I don't expect that to happen. But if we are in that higher longer for environment and stocks can bump along quite nicely for a while, that doesn't mean they keep doing it, because after 2024, again, all the volatility around the upcoming election, then again, you've got this direction of where are we going? And I think geopolitical tensions, political tensions will escalate significantly, and we will start to see further structural change. And I do think it is 2 steps forward, 1 step back, and with wild cards like AI, for example, no one quite knows what that means or where it will go. But generally speaking, in favor of construction, infrastructure, physical production where it can be done. It is in favor of countries who are closer to the US geographically, like Mexico, or politically closer to the US, like India, Vietnam, vis-a-vis China. So opportunities there. In terms of FX, if we are not going to see rates slashed, I still back the dollar. It's taken a big knock recently because everyone thinks they are going to slash rates. It will go back up again and test a new high, as yields could too, if everyone realizes that they're not going to do that. Big bear on the MFX in general on that basis. And I remain, very bearish on the outlook for anything and everything associated with China.
And just expand on that for just a sec. Why are you so pessimistic on China?
Well, I've been a bear on China for ages, just
I
because.
know.
By the way, that's been completely held up by the performance of their asset markets. So I'm quite pleased with that call, even if I don't make that recommendation per se to anyone listening. Their structural problems are even larger than the US, and they're grappling with all the same problems that the US has got, except they have a collapsing demography too. And at the same time, they can physically produce a hell of a lot of stuff that the US can't. So they have no problem building a ship a week. You know, they can build an incredible amount of planes and tanks, munitions, whatever they need. They build too much. That's their problem. And you know, there are all kinds of questions you can start asking about what do you do when you've got too much of stuff. But it's more fun to be in a position of not producing enough, and having that J curve to pivot towards starting to produce enough again, vis-a-vis producing far too much and gradually losing clients who start saying, well, I don't need to buy from you, thanks, I'm going to make my own.
Yep.
So of that seesaw, I'd rather be on the side going up than on the side going down.
All right. Super unfair question to ask at the end here, but I'm just going to ask it anyways. And we could talk about this for a whole hour or several hours, but just to the point you raised there, for a country like China that still has a massive population, can make a ship a week, and perhaps maybe beginning to realize it has diminishing prospects. Is there a risk of China becoming a little more aggressive on the world stage than it's been?
Well, first of all, China is already aggressive on the world stage. If you look
I
at
know,
what it,
but more aggressive. It historically has not invaded other countries.
well, it did in Vietnam in the late 70s. But the answer is, first of all, you have to wait and see what some of these elections coming up bring. For example, we've got one on the 13th of January in Taiwan. Let's see what the Taiwanese election brings, first of all. That could really be a wild card that not enough people are talking about, particularly if the pro-independence party wins again and has, you know, difficult rhetoric alongside that, you know, really rubbing China's nose in it. That could be a real problem. But I think the best thing to do is just to defer to, you know, military experts. And there you have a broad range of opinion. Some of them say absolutely nothing to worry about, no. And others say absolutely you shouldn't be sleeping at night.
Mm-hmm.
And so I will leave the viewers to decide themselves which one they should be listening to, but it's going to be one or the other. And where's your risk reward in terms of how you're positioned if it's the opposite one to the one you've chosen?
Yeah, got it. All right. Well, look, Michael, thank you so much. I want to get to my very last question for you, which is one I've just started asking people on this channel. It is what sort of non-financial investment would you encourage people to consider investing in right now in their lives? I've gotten some really great answers. Before I ask you that, just a couple other quick housekeeping things. First off is most important for folks that have really enjoyed this conversation, Michael, and would like to follow you in your work, where should they go?
Have a look on LinkedIn. You'll find me there. And you know, the highlights of my work can be found there, and I'm very happy to continue a discussion.
Okay, well, you're very kind to offer up your LinkedIn to folks that may want to reach out to you, because I'm sure your framework has gotten a lot of people's attention here. All right, so Michael, let's get to the last question here. Beyond all of the, you know, oh my gosh, should I be buying stocks, bonds, commodities? What's going to happen with interest rates? Just in terms of the, you know, investments that somebody should be considering to just increase their odds of living a rich life. What would you recommend folks consider?
I'm going to give you a very strange answer, I think, but it's one from my own personal experience. I wish I had taken the advice of when I was a kid. Get your feet checked. And I say that because a very, very high percentage of people actually require orthotics in their shoes to stabilize their gait and their walk. And if you do it when you're young, in particular, if you've got kids, if you get them checked when they're young, you can find that with relatively cheap preventative action, as in physically getting the foot scanned, the orthotic made, put in the shoe, and then making sure the child wears them, And I was a child who was given them and threw them away because I wasn't interested in that, playing these silly games, and no one followed up. You can prevent extremely expensive long-run problems with your back, with your neck, with your ankles, with your hips. You can save yourself tens of thousands of dollars, if not more, over a lifetime in cumulative medical expenses, which could have been going into your pension pot and growing at whatever a compound interest rate you're lucky enough to get. That instead you have to have as a running cost just to maintain a barely functional physical frame, just because you didn't start with literally a basics ground up approach. And my economic philosophy is based on political economy and realpolitik, which is ground up. How do we start from here and go up? Do it with your feet too. Go ahead and check. And even in at our age, in your 40s and your 50s, you'd still be surprised how much healthier you can be if you're walking right.
That's what I love about this question is I'm just getting answers that I just never could have thought of, and they're excellent. And I'm a huge fan of investments like that with a little a small amount of care and effort early on, you can either save yourself tremendous costs, amortize it over the rest of your life, which is awesome, but also increase your quality of life. Right? You sort of talked about the cost savings of all the surgeries or corrective, procedures and stuff like that. But just think about the enhanced quality of life of somebody who doesn't have to deal with all those issues, right? So I'm somebody who I didn't get braces until I was 40, and once I did and have benefited from that, I've realized how much anguish I'll save myself in the rest of my life. But thinking, my God, if I'd done this when I was 15, my God, I would have had several more decades beforehand of freedom from all the issues that it had caused.
I completely agree. I mean, I'm not trying to eulogize any one doctor or any one clinic. I'm not selling anything, but that basic health-based approach, I think, is where you should start.
Well, the podiatrists in our viewership, thank you for this, Michael. Michael, I can't thank you enough. It's always a complete joy and a fascinating learning experience talking with you. Really appreciate you giving us so much time today.
Bye-bye.
All right, well, now's the time in the program where we bring in the lead partners from New Harbor Financial to both react to Michael's commentary right there, but also talk about what's going on in the markets right now and how they're reacting to it in real time. I'm joined as usual by lead partners Michael Preston and John Loder. Guys, thanks for joining me. John, let's start with you. That was a big and intellectually gripping discussion there with Michael. What were some of your key takeaways?
Yeah, hello, Adam. Great to be with you and your viewers again. I always enjoy Michael's perspective. As you pointed out in your opening remarks with him, he is a different part of the world than we are, finding himself in Singapore, so it's great to step outside of our boundaries here in the U.S. Look, our job, Mike and my job and our team's job here for our clients is every day on the street. We're in the trenches, and we're watching the daily and short-term machinations of markets, but we have to have a big picture frame of reference to put the cycles of things into context. And we know, from history, cycles do play out, and they play out in very slow-moving but important ways. And I really appreciate perspectives of folks like Michael's, because it helps to put into the context of the cycles of things. And of course, we've talked at length, and you have talked with your guests about the cycle that we might recently call the central bank cycle. I know we're not on mainstream TV, so I get the luxury of repeating some choice words that Michael shared. We have an era of frivolity and bullshit that has largely been stoked by just monetary policies that have really intervened in massive ways in the economy and especially the financial markets. And here we are, we're just a little over an hour and a half away, Adam, from the Federal Reserve's announcement on interest rates and their policy messaging. And if there's one thing that the markets over the last month and a half, I guess, have proven, is that markets are still utterly addicted to monetary policy moves. If you look at what's happened in the market expectations, and we'll find out in, again, just an hour and a half as to what if any policy decisions they make in terms of short-term interest rates today. We don't, and the market doesn't expect they're going to do anything but stay put for today. But the real key is their messaging about the potential for future rate changes, and especially pivoting to starting to drop short-term rates. And in fact, the market has utterly gotten presumptive that the Fed is not only going to start dropping rates, but dropping them pretty meaningfully as early, and the date expectation has been moved up. By next summer, I think there's over 90% expectation that the Fed will have already started easing by then, and as early as some odds of January, but March, and as we get into the spring. I want to share a couple pictures, because as addicted as markets are to speculating on that, one thing we know, and we can see it in the data, is the market is very poor at predicting what the Fed is doing. In fact, you might even say the markets are stubbornly petulant and spoiled here, because Jerome Powell has done a pretty good job, we think, at messaging that look, we're not done here. We can't let the fight for inflation, to tame inflation. We can't quit that fight too early and repeat the mistakes of the 70s. We had an inflation report a couple of days ago that came out okay. In fact, there were some things there like super core, not going to get into the details, but came in a little stronger than expected. But let me share a couple of charts just to kind of show you what I'm talking about here. So this is a chart that is courtesy of Jim Bianco. I know you've had Jim on your program many times, and he's always a great source of perspective. What this chart is, it basically shows the market's guesses at the path for future Fed policy rates. And that's what all these kind of like squiggly lines are. The dark black line is actually the actual rate. So you can see all these misses from that dark line is essentially the market's getting it wrong. And we think, and we'll find out again in less than a couple hours, we think the market's gotten utterly too presumptive about the Fed starting to cut rates, at least at the degree and pace which the market expects. And one reason for that is the financial conditions have loosened dramatically. This next chart, again, courtesy of Jim Bianco, shows the Goldman Sachs Financial Conditions Index. And basically, this is essentially an equivalency of Fed rate reductions. And you can see since late October, and this chart only goes through November 23rd, I guess, not even this month to date. But you can see there's a massive loosening in financial conditions. Interest rates dropped, stock market rose very, very, very considerably. Oil prices came down. So that's effectively the equivalent of about a full percentage point drop in the Fed's target rate. Now,
and hey, John, just to be super clear, the Fed didn't drop its interest rates, nope. but bond yields came down, is what you're talking about, right?
Well, this is the point I'm trying to make is when Powell gave a pretty dovish commentary the last time around, he did so, and his peers did so by saying, hey, the market's doing the tightening for us, so we don't have to tighten so much.
Right.
Okay? And right after that happened, the market effectively loosened financial conditions. Basically said, oh yeah, well, we're not tightening anymore. Because at the time, interest rates spiked. The 10-year yield was about 5%. Stock
5%
down. Yeah. Right. Since that time, essentially all those things that Powell pointed to as the market doing our tightening have reversed. Stock market has rallied considerably. 10-year treasuries peaked at 5, came down to 4.2 area, oscillating around there. Point being is that the market went right to assuming the Fed is going to pivot and start to reduce, and at the same time front ran that. So I think there's a pretty good chance, and we'll see, that Powell comes out and say, look, we spoke about tight financial conditions, but they've loosened. So we're not going to be so quick as the market thinks to lower rates. And even if they do,
sorry to interrupt, I just want to underscore the point there that a lot of people just sort of think as the Fed is all powerful. And we just need to underscore for folks that it is a multifactorial situation there. The Fed is quite powerful. There's no doubt about that, but it does not have all the power. And the market can do a lot of things to stymie the Fed's objective here, as can the fiscal side of the house, as can Congress and the administration. So I think one of the reasons why people have been so surprised by how things went in 2023 is because you've had a lot of cross currents in the different parties here, right? You've had Powell say, we got to get things really tight to get inflation under control. We've had the market at every point saying, I don't believe you, I'm getting ready to party more. And you've had the fiscal side basically stamping on the economic accelerator while the Fed's been trying to step on the economic brakes. So it's much more complicated than just what the Fed does, is what I'm trying to.
Exactly right. And I just want to, again, the market is cheerleading or expecting a pivot. And, I think our simple comment to that is one might better be careful about what one wishes for, because as much as we've been trained to think that the Fed, coming to the rescue, lowering interest rates is a salvation and a reason for markets to go higher. That's not always the case. And in fact, if you look, this is a chart that we put together, shows the S&P 500. This goes back to the early 90s. This is the Federal Reserve target rate lower bound. And then these red dots are basically dates on which the Fed tightened or increased short-term rates. And the green dots are dates where they lowered rates. And what you see, the last two bubbles, the tech bubble and the housing bubble, in both cases, the Fed actually pivoting and dropping rates was certainly not a savior. In fact, that you might even say was an accelerant to an over 50% sell-off here and over 60% sell-off here. And there have been times, yes, when the Fed has lowered rates and markets have rallied. But if you look, there's not a consistent pattern. But typically, when valuations are super, super high, like they are now, it's been more often the case that markets actually decline when the Fed is dropping rates. And you might even say the Fed is dropping rates not as a proactive measure, but as a reactionary, hope to stem the selling. So we don't doubt that the Fed might stop. Might start dropping rates, but we think the premise of a soft landing and that being the reason is probably a bit off, and we'll probably see them start to cut only when the market is and the economies are starting to show some real cracks.
I really appreciate you bringing up that chart, John. I've shown variants of it before to warn people that when the Fed plateaus after a rate hike regime, history is pretty clear that, I don't think you had shaded recessions in that chart, but history is pretty clear that that's when recessions are most likely to happen, right? Is once the Fed has plateaued for a while. Well, as far as we know, we are plateauing. We'll find out in an hour and a half, what their latest move is, but it's highly expected to stay. They're not expected to change the Fed funds rate today. But that chart does a really good job of saying, hey, when the rate hikes end, and then when the Fed starts cutting, that's when you want to be really nervous about the markets, because much more often than not, that's when the market starts plunging, right? And as you said, John, usually the reason the Fed is starting to cut there is because it has realized, oh my gosh, we over-tightened, the economy's slowing a lot more than we thought, and we got to start scrambling here to try to start easing things. So will history repeat this time? We're going to find out. But there's a real preponderance of historical evidence that we know how this script plays out. Mike, I'm going to come over to you real quick. John, any other charts you wanted to show? I don't want to leave you hanging. We just don't have time.
No, that about does it. We happy to turn over. Just want to make
okay, because I want to talk about the trades that you guys have been making at New Harbor, because I know you've been making several recently, largely in response to the extremely low levels of volatility we're seeing in the market right now. Really quickly, I just want to give a shout out to Michael. So if you remember the conversation that I just had here with Michael, he talked a lot about how, steps that nations were going to take to become more resilient, less dependent upon their trading partners. We talked a lot about America and China. Literally just a couple of hours after I got off with Michael, he sent me this an email with a link to this report that was just released by the House Select Committee on the Strategic Competition between the United States and China. It's called Reset, Prevent, Build. Those are sort of its three tranches here. And it essentially walks through exactly what Michael was talking about, right? This whole strategy that he said he's been focused on for a couple of years now. So this House doc has three pillars. The first is reset the terms of our economic relation with the PRC. relationship with the PRC. And it says here that, they're taking advantage of a lot of our issues. They're not abiding by the things we want them to abide by them. And so, we basically have to do a trade reset with them. Pillar 2 is stem the flow of U.S. capital and technology to them, because that's fueling a lot of things that we don't like there. And then Pillar 3, invest in technical leadership and build collective economic resilience in concert with allies. So this is very much the friendshoring and the reshoring that Michael was talking about. So I just wanted to sort of say that this was a real-time validation of his strategic thinking there. So again, wanted to give credit where credit is due. Mike, let's come over to you now. What have you guys been doing recently in your core portfolio there at New Harbor?
Thanks, Adam. Yeah, I'd like to just do a recap of some recent changes we've made or are in the process of making right now. It's a number of things happening in the market that we're noticing, and we're living in pretty crazy times. The last 10 or 15 years have been unusual, to say the least, in terms of how markets have changed and how monetary policy has been so extreme. I will go ahead and share a chart here, and I'd like to start with volatility. Volatility, it's basically a measure of risk, and it's at all-time lows here, or not all-time lows, but multi-year lows. Take a look here at the daily chart of VIX, or volatility. It touched 11.81 yesterday. This is an utter collapse over the last few weeks, last month. We went from 22 to 11 in a very, very fast fashion. I'll go to the weekly chart. You can see that we're at a 2-year low. Go to a monthly chart, and I'll just zoom in on this part. I mean, you can see that we're essentially at levels last seen back in 2019 and early 2020. So, that's before even the COVID spike. This huge spike here is COVID. We haven't seen these levels since before COVID. So really, this is a reflection of complacency in the market. There's very little fear of a big drop. And ironically, that's when you do have to start to be worried about that type of thing. But what we've learned in the market is it can go a lot further than you think. This could very well go even lower. The market could have a blow off top in the next weeks and months. And in fact, what we're looking at in the market is starting to build evidence for that. Let's go to the S&P here briefly on the daily chart.
And just while you're pulling it up, Mike, I will say that a number of the recent guests on this program, Felix Zulauf being a very recent one, are seeing increasing indications that the market is more likely to power higher into Q1.
Well, that's what it's looking like to us. We don't like to make predictions, and particularly to the bullish side, when honestly we think the macro picture and the fundamentals are very bad, very bearish. But we have to admit that certain things are lining up and telling us that the near-term direction is up. If I want to just quickly go to the weekly chart on the S&P, this is a weekly chart on the S&P. And back when we had this big bar here, this up week, we became concerned of a breakout in the S&P. And this was at the same time that our short-term indicators were reversing up. We've got a number of things we look at: market breadth, participation, sectors that are leading, that type of thing. And of course, valuations are terrible, but in the short term, we throw that out a little bit. And we say, okay, what's the market actually doing? Here we became concerned, that we were going to get some kind of blow off top. Now, I wouldn't call this a blow off top, at least not yet. But it has been, we're on the seventh straight up week. It's been a pretty relentless rise. Just shared with you, volatility has collapsed to levels last seen in 2020. When this downtrend was broken, we adjusted our hedges. The first thing we did was adjusted our hedges. We had in the money December puts up at 4,500. We sold those, took a profit, and we replaced them with puts that expired in January at 4,100. Now, the low volatility that we just talked about has given us the opportunity to do some different things. For instance, we are rolling out our hedges from January to March. That low level of volatility means that options are cheaper than they were before, because one of the largest components in the Black-Scholes models, which dictates option pricing, is volatility. So when volatility is low, options are cheap. So we have, are in the process of rolling out our hedges for a 15% notional position roughly in our accounts out to March 4100s. Now that's a ways down there, right? It's a little over, maybe 10%. But the way that we look at it is this: we've got around 27%, 30% stock exposure, not including gold mining stocks. Most of that is in emerging markets where we think valuations are compelling. What we want to do is have some kind of crash protection on a good portion of our net stock exposure. So we've increased a little bit, a little at a time. We're up to 27.5%, 30%, and we actually maybe increase a little bit more in select sectors if we continue on this move higher. But we are concerned about crash risk at any given time. So the put options that we have in place for 15% essentially say after a 10% deductible on that stock allocation, our put options protect us against further declines. So the tricky thing about a potential blow off is you don't know when it's going to turn. You don't know how high it's going to go. You have to try to ride it with part of it. Yet it could fail at any time. And so the low volatility gave us the ability to adjust that. One more thing that we are doing this week and in the process of doing is making some adjustments on our bond position. Let's take a look at TLT. Here's a daily chart of TLT. It's been a really epic collapse. We've talked a lot about it. We got caught in it a little bit early. We defrayed some of that downside with our put options, but there's always a deductible. Well, back at this time when we were getting dozens, if not hundreds of calls from both clients and prospects and people that watch your show, Adam, a lot of people wanted to talk. There was a lot of capitulation here. It doesn't mean it's the ultimate bottom, but you can tell from being in this business for as long as we have, when we get that kind of response, that it's probably a near-term bottom. And the 10-year yield went from about 5.2 down here on TLT to about 4.2 now. So, but this has been a really fast move. We're back up between the 50 and 200-day moving averages. This oversold condition has been released or relieved somewhat. And now we have a huge, Fed decision here in about an hour and a half. If the Fed stays pretty firm, and we think they will, then this may have gotten a little bit ahead of itself. We will see. That's what we're concerned about. We ultimately think long bonds and TLT will go much higher, maybe above 120 or 130 on TLT, particularly in a stock market meltdown. But this move's been pretty fast, and the risk of a retracement is pretty high, particularly because bullish positioning in bonds is very, very lopsided. So there's a lot of bullish positioning, even though there was somewhat of a capitulation back here. Money managers are pretty darn long. Maybe retail capitulated, but the numbers on institutional managers is pretty long. So lastly, we're adjusting our hedges on TLT, establishing a call position, a short call position up here at just over 100, and using the proceeds from that sale to buy some puts down in this area in the high 80s. So these are the purple lines. We're doing that on all of the position, not half. And yeah, we might get a further move higher, but this is not going to be a V recovery probably. It's going to be a process of ups and downs. If I were to go to the last thing I'll show you here, the weekly chart, last time we had a big down move, we moved sideways for a while. So, whether this moves sideways here or goes a little higher than moves sideways, it's probably not going to be a V-shaped move. And you can see that pretty well here on the monthly chart. A bounce. Here's like 8 months sideways. And so it's not likely that within 2, 3, 4 months, we're going to go right back to 110. It's probably going to be more sideways. So I'll pause there.
All right. Well, thanks so much for walking through that, Mike. And it does a great job of showing people how you guys think and are reacting to market conditions. But because you guys are so skilled at using options, not as a speculative tool, but really as a protectionary instrument, I think it's super valuable how you explain to people how you're doing that. So on TLT, you guys are remaining in the position, right? You're just putting some sort of insurance around it, but you are remaining in it because over the course of the next year plus, you think treasury bonds prices will grind higher, may chop around for a good bit, like you said, Mike, but the long-term trajectory will be up.
I believe so. I know you've had a number of guests on recently. I believe Felix Zulauf the other day said he thought maybe we would drop to 3.6 or 3.7 on the 10-year and then go back above 5 again, and then maybe lower later. We think that yields will go lower than that over time. We don't want to hold bonds for 10 years or 20 years, but we do want to hold them for maybe 2 years. Because we see the 10-year going down perhaps into the 2s on the yield if we get a real big stock market drop, like we think we will at some point. But we just don't think it's going to be a straight line. So TLT, as I said a minute ago, probably will go back into the mid 100s, 120 to 150 range, something like that, if that happens, if we drop back into the 2s. But we're probably going to have a retest of the lows on price and on the highs on yields. And I think Felix basically said that the other day on your program, and we tend to agree with that we'll probably see 5+ again on a retest. So we want to stay in the position. Let's put it this way. We want to stay in the position to ultimately achieve that higher return. It could take a year. And the best way we know to stay in the position to have your cake and eat it too is to continue to adjust the parameters on our option hedges. Basically, we put guardrails on the position.
Right, so that you limit your downside. Yeah,
that's right.
All right, excellent. Well, guys, thanks so much. Just one last thing I want to note for folks, and I want to thank you guys for coming on too. It's been a little bit of a chaotic week in terms of planning out the content here. We had a few curveballs we had to react to. So I appreciate you guys coming on now to film this reaction to Michael. As you guys said, this is going to air over the weekend, so folks are likely watching this. If they're watching it the day it goes out, it's already Sunday, so the world will know the results of the FOMC announcement and whatever Powell says in his press release, which is coming up now in about an hour. I just want to flag for folks that later on today, the day that I'm actually recording this, I will be doing a live Q&A with Fed watcher Axel Merck, where he'll be interpreting for us what he took away from the Fed minutes and whatever Powell has to say. And we'll be taking live Q&A from the audience. This is going to be for the premium subscribers to my Substack. This is the first time I've done anything like this. My Substack's still relatively new, as most folks know. But I'm always trying to think of ways in which I can increase the value of a premium subscription. So my premium subscribers will be able to participate in that live discussion with Axel, and they'll be able to ask any questions of Axel they want to. The replay of that video is then going to release the next day to everybody, to the world. So if you're watching this on Sunday, that's already on this channel. And so if you want to hear what Axel had to say about Powell's commentary and his guidance, you can go watch that video after this one. But I just want to note for folks that we continue to try to evolve that Substack channel. Two things that are worth noting. One is that there is going to be a price increase. I just launched the channel about a month ago. I've been publishing my Adams notes to it, which there is a cost to. Now that I'm beginning to get a better sense of the business, I need to bump up the cost a little bit. It was really cheap. It was $8 a month. It's still going to be very cheap. It's going to be $15 a month. But if you are a current premium subscriber, do not worry. Everybody who's currently subscribed is going to stay at that $8 a month or $80 a year price for as long as you remain subscribed. So you'll be grandfathered into that. You don't have to worry about your price going up. The price increase I'm not going to do until January 1st. So if you are a current subscriber, free subscriber to the Substack and thinking about becoming a premium one, if you decide you want to, act before January 1st so you can lock in the current price and get grandfathered in on that as well. And if you haven't subscribed at all yet, just subscribe now for free. It doesn't cost you anything to become a free subscriber. You'll get all the content that I share multiple days a week through that Substack. And whenever I do something new like this Axel event for premium subscribers, I do let the whole community know so that if you decide, oh, this is the thing I want to participate in, you can subscribe at that moment and jump on in. All right, enough details about that. If you've enjoyed this conversation with Michael Every, would like to have him come back on the channel, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. John and Mike, guys, thanks so much for joining me for another week. Everybody else, if you want to watch that Fed reaction video with Axel, like I said, it's now available. I'll put up a link to it right here. Gents, Mike and John, we'll see you next week to see, get your guys' thoughts on Powell's commentary here. Everybody else, thanks so much for watching.
Goodbye for now, Adam. Thank you, everybody.
Goodbye, Adam. Thank you. We'll see you soon.